So we're going to finish up here with selling options for income, profits, and opportunistic hedging trading workshop. So let's get started. The following webinar course is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. So we're going to look at, hedging core positions. And again, when you combine vertical spreads, a debit spread with a credit spread, there's just all types of different matches that you can make, kind of like, puzzles to figure out. So it's a great strategic way to hedge. You can think a couple steps forward on every trade once you get, the fundamentals down. So we're going to look at, hedging strategies for the vertical debit spread and credit spreads. And the hedging foundation, again, is based off of offsetting vertical spreads. Okay, so it's very simplistic once you think through it. So, when you're looking at, a butterfly long condor spreads, they can be used as a really fast, quick way to execute a hedge on a position that starts to move against you. So by either constructing a butterfly, which we'll go through, or a long condor spread around a strike that is under pressure from another core trading position you have on, such as you could have on a credit spread or a debit spread, this becomes the best and quickest way to neutralize and reduce directional trading risk. And it will also, that also, in my opinion, lowers stress. When you lower your risk, there's, a lot less stress as far as, worrying about trades as much. So the strategy allows you to keep open your original position by implementing that butterfly or long condor hedge against it. And what it does is it takes advantage of the time decay element or component that's a big component of the butterfly and long condor. So it lets you kind of wait out. A lot of times, you need to just kind of, a trade stalls, and you have to kind of wait it out a lot of times before it'll start getting going again. So we see that so many times over and over and over. You can just be pulling your hair out. So by doing this type of defense, it's a really great way to neutralize the trade, but also take advantage of that time decay while you wait it out. So a lot of times you just need that little bit more time to let the original position stabilize, and then it moves back in your favor. At that point, there are a lot of different things you could do, but one, you just remove the hedge, stick with your original trade, ride it for all it's worth. So again, the fundamental foundation for these types of defenses is just offsetting vertical spreads. So we've got the vertical debit spread, the vertical credit spread. So again, the vertical debit spreads, you've got the bull call debit spread. We've been through that, so I'm not going to go through the details, but it's all there. We went through that, over the course of a number of times. And then you've got a bear put debit spread. So the bull call debit spread is bullish. The bear put debit spread is bearish, and these are defined risk because it's the debit paid. Okay, so that's your risk. Now the other side, offsetting side of that, or the opposite, is the vertical credit spread, and you've got the bear call credit spread. These are premium collection strategies. They're going to take advantage of selling premium for time decay and also implied volatility, collapse. And then you've got the selling the bull put credit spread, which is a bullish strategy by selling puts, but having it hedged with the, buying a put below it. And again, you're selling time and you're selling volatility. So these are two vertical spreads, but offsetting. So when you when you combine them together or match them together, they present a great way to hedge and neutralize the risk from one, basically matching the other one against it. So we'll go through some examples to show you, but once you get it down, it's just amazing what you can do with this type of hedging.